In this video, we will look at the role of company analysis in fundamental research. Think of a company as a micro unit within a much larger system. It sits inside a specific industry, which itself sits inside the broader economy. While external conditions like macroeconomic factors and industry trends drive a company's fortunes, the individual performance depends heavily on company-specific factors. As an analyst, you must drill down from the outside in, finding answers to questions that are specific to the company to understand its true potential. Once you have narrowed your focus to the company level, imagine you have an analyst dashboard in front of you. There are 8 critical questions you must answer to assess a company. First, what is the business definition? Second, what is the business model? Third, does the company enjoy a competitive advantage? Fourth, does it have the capability to exploit opportunities and withstand threats? Fifth, is the management competent? Sixth, is there a clear vision and visibility for the future? Seventh, is there a governance structure in place? And finally, is that governance properly executed? You cannot rely on superficial answers here. You must obtain data that substantiates your findings for each of these points. Before we go any further, we must address the most fundamental question. Imagine a large stop sign in front of you asking, "Do I understand the business?" To pass this gate, you need clear criteria. You must be able to answer, what does the company do and how does it do it? Who are the customers? Why do they buy the product? And how does the company serve them? As the legendary investor Warren Buffett says, wide diversification is only required when investors do not understand what they are doing. It is far better to invest in a few companies you understand well rather than many you don't. To truly understand a business, you must also look at the specific metrics relevant to its sector. Different industries use different yardsticks. For the retail sector, we look at footfalls and same-store sales. For banking, the key metrics are net interest income and net interest margin. In the telecom sector, we track average revenue per user. And for hotels, it is about average room tariffs. As Dr. Gary Hamel notes, competition in the marketplace is not between products and services, but between the business models of the competing companies. A key part of a successful business model is pricing power. Let us look at pricing power and the sustainability of this power. Pricing power is the ability of a company to independently determine prices, pass on input cost escalations, and grow margins when demand is strong. This is often driven by 3 industry drivers. First is competition intensity, second is the price elasticity of the product, and third is the level of commoditization. Most often, these factors affect all companies in the sector, determining how much control they have over their own pricing. However, some companies have specific factors that allow them to outperform the industry averages. There are 3 main pillars here. First is natural leadership. For example, smaller petrochemical players often price their goods based on Reliance Industries Limited or RIL because RIL is the market leader. Second is brand affinity. If a company has strong brand perception or loyalty, it can price independently. Third is cost base. A low cost base allows for competitive pricing that peers cannot match without becoming unviable. Studying these factors helps identify which player is likely to outperform its peers. Now let us look at the broader picture of competitive advantages and points of differentiation over the competitors. In every industry, some players do better than others. To understand this performance versus competitors, we can look at a triangle of factors. At the top, we have differentiation in product features. On one side, we have competitive pricing driven by operational efficiency. And on the other side, we have better execution. A company needs to excel in these areas to stand out. Let us break down product differentiation. This begins with an innovation cycle. A company needs a strong research and development team plus a culture of innovation. This leads to better features such as higher quality or better functionality. These features create a value proposition which allows the company to attract more customers. But as an analyst, be careful. You must compare products to see if features are truly better. Look for data to substantiate the advantage and do not just accept superficial marketing claims. Next, we have competitive pricing. This is often a weighing scale. On one side, you have a low cost advantage, which is sustainable because competitors cannot sustain lower prices without losses. On the other side, you have price cuts without efficiency, which is unsustainable because competitors will mimic the strategy and the advantage is lost. You also face the like for like challenge. For instance, comparing a Toyota Camry, which has more features, versus a Honda Civic, which has a lower price. You must identify which offers better value for money through primary research and past model performance. Finally, we have execution. This is about communicating better or executing a sales strategy through a focused approach. We can see this in how major Indian companies operate. Flipkart focuses on branding. Airtel focuses on advertising. Haldiram uses strategic alliances. And Hero MotoCorp succeeds through positioning. Execution capabilities are studied by looking at the past track record of the company and its management. This tells you if the company can effectively deliver on its promises.